Have you ever really wanted to know the truth about Dave Ramsey's advice on infinite banking and didn't know where to turn? Have you been frustrated with his quick to judgment answers and kind of over the top language about what should be a pretty logical conversation that ends up being turned into name calling? If you're like most, you're looking for the truth. And while YouTube is not the best place for unbiased advice, we hope to give you as much as we possibly can here and avoid the financial infotainment wars that Dave seems to be sharing and spreading on his video channel. So again, my name is Mark Willis. I'm a certified financial planner, and apparently I have a beef to pick with Dave as he's been picking some bones and beef with me. So now's our chance, I guess, since he recently came out live and talked directly about something that we talk quite a bit about on our shows, the infinite banking concept, aka bank on yourself. Brandon and Amanda, introduce yourselves quickly, and then we'll jump into what we're going to be covering together today.
Hey, Mark, thanks for having us. Brandon and I work with you as clients for about 7 years, and now we're also doing similar things to you do. We host a channel called Grandma's Wealth Wisdom, and I do a show called The Fife Movement. We've talked a lot about Dave on that show and what he gets right and what he gets wrong. So I look forward to jumping into what that means for infinite banking with you today.
Yeah, and I got this video this morning from another friend who does a YouTube video, and he's like, hey, this guy just happened to post something about what you do. And I was like, oh, great, here he goes again.
That's right. And it does come down to us finding solutions that bring real answers to our clients. And there's nothing that solves the problem better than a radio program or a TV YouTube channel, answering a question within 30 seconds, which is exactly what Dave Ramsey seems to want to do with his programs. Now, I want to jump right into what he's covering on his short video. And, you guys can go find his video. Just search Dave Ramsey Infinite Banking on YouTube. It's one that was dropped today, November 23rd, 2020. And he says that infinite banking is a scam. That's the title of the YouTube video. But I'd like to say, and I'd love to get everyone's comments below as you're watching this video, is Dave Ramsey's advice on infinite banking the real scam? So that's what we're going to be covering on our short video today. The first thing that really caught me was that, okay, the caller calls in. He's from Detroit, Michigan. His name is Jason. That's all the information we have. We know that he's been working with a financial advisor who's been giving this person advice, and he's on baby step 7. So this guy is on baby step 7. And in that language, Dave Ramsey's language, that means he's got 3 to 6 months of savings. He's got his entire house paid off. He's been investing for his retirement, and he has excess money in his savings account. That's all the information that Jason shares with Dave Ramsey, before Dave comes out and screams, "Jesus, you're kidding me." When he hears the words infinite banking, he yells out, "Jesus, you're kidding me," like someone just told him he had terminal cancer or something. So, that's literally all the fact finding that Dave Ramsey has before he's completely convinced that he's in a terrible situation. And so, guys, this client, Jason, whoever he is, has been given a financial asset that's been guaranteed to grow every single year for the last 160 years. And he says in the video, as he's describing this to Dave, that this policy's cash value breaks even in year 7 with an untold larger death benefit, many times greater than what you've obviously got or paid in contributions. So it's not meant to supplement the investment portfolio this Jason guy has. But Jason even says to Dave Ramsey, the dividends will even pay for my policy after the 7th year. And he says, it doesn't sound like a terrible idea, Dave. And he's also working, I'd say, one more piece to this, and I'd love to get your thoughts, guys. He's working with a financial planner who assumedly has listened carefully to Jason's objectives, unlike our wonderful radio show guy, Dave Ramsey. So do you think this planner might have more insight into the financial objectives of Jason than Dave would? Jason made it 30 seconds into his conversation with Dave before he has an opinion. Not just an opinion, he's showing veritable disgust on his face. So, I mean, that's really, in my opinion, that's what Dave Ramsey does so well. He gets you to feel his opinion rather than having to back it with reality or facts. Guys, what are your thoughts?
I want to talk to Jason and ask him, why'd you call into Dave in the first place? Do you really want Dave's opinion, or do you want him to validate why you shouldn't do this? Because it's really easy to know what Dave's opinion is about infinite banking. It's been out there for a long time. What was the reason for him calling in, and did he get that reason, right? If he was looking for a validation why he should not do this, he got it.
Or was it staged? Could have been
yeah,
staged.
yeah, could be. Wow, so true. Now, one thing Dave gets right is that he rightly points out that there are two types of life insurance companies. There's mutual and there's stock owned. And he goes into what those mean, where if it's a mutual life insurance company, you, the policy owner, own the insurance company. But then what he does next is kind of interesting. He says, all right, you're the owner of the company. You're also the customer. And he says his words from the transcript are, if you're the customer and the owner, the only place the company gets profits from is you. Now, what do you guys say to that? The only place that these insurance companies are making money is the policy owner's pocket.
I would say that is absolutely incorrect, because they do a lot of other things to make sure that they are profitable, including selling term insurance and other things that help them to be profitable.
Amanda, what about you? You mentioned this offline. Is the only place these mutual companies taking profits is just straight out of our pocket, like it's pure expense?
Right. So that's one of the things that a lot of these whole life insurance companies also sell term insurance, and they make sure they make a profit off of those term policies. It's something like 99% of them never actually go paid. So the premiums that have been paid year after year after year on those term policies are pure profit for the life insurance company. As a whole life policy holder, guess what? That's part of your dividend too.
Yeah. So what you're saying is there's term insurance premiums that aren't going to pay out a claim this year that you and I and Brandon and all the other whole life policy holders are going to receive part of that as part of their overall profits. I went ahead and looked up what mutual and publicly traded life insurance companies have as their portfolio. And I don't know about you, but I don't see 100%, ripoff. I don't see 100% scam on that portfolio breakdown. Do you guys? I mean, it's not like this is some sort of Ponzi scheme. There's quite a bit in public and private bonds, cash, equities, mortgage loans, real estate, and policy loans, of course. So the policy holders are not the sole provider of the profits. He's simply wrong when he's describing mutual owned companies. And you're right, Amanda, if 99% of insurance policies never pay out, then you lost every penny you ever pay into that term policy, didn't you? And where did that money go?
Yep.
Went to the company that whole life insurance owners co-own together. Now, he goes on and he sort of talks about the cost of these policies. So I thought I'd bring this up quickly, guys, and pause the video if you want to see these numbers here. But here's somebody who's putting in an unbelievable 40 grand a year into
a whole life policy.
Into a whole life policy.
Oh my gosh.
So Dave Ramsey would just be, keeling over and, throwing back some tequila shots or something, because that's just unbelievable. Who would ever want to do that? Well, we did the cost analysis. In the first year, it cost this guy $13,000 to put money into a whole life policy to get a $1.7 million death benefit. And I got that 13 grand. If you take 40,000 minus that first year's cash value of 26,967, that's a spread of 13 grand. See what I did there, guys?
Yep.
All right. And then as year 2 and 3 goes on, the last year the policy grows less than your contribution is the third year. In other words, the net expense is gone after the third year with a grand total expense of $27,000. Now, this is unbelievably expensive, and who would ever think to do something like this? And why would you ever consider putting money into a whole life policy? Well, after the 9th year, he was complaining that dividends are an overcharge of premium, that these insurance companies overcharge you and take more money out of your pocket than they should have, and that the IRS officially refers to dividends as a direct overcharge of premium, his words. Yep. So we're looking here, and after the 9th year, we have received a dividend of $27,000, essentially all that the cost of the policy ever was. See how that worked out there? So in the third year, we've spent a total of 27 grand for life insurance. After 9 years, we've gotten all the dividends, have paid for our expense. And by year 20, we've literally got 4 times as much dividend as the policy cost us. 4 times, $113,000, almost 4 times as much as what the policy cost us. So
Wow.
I simply don't know what else to say to poor Dave, but maybe he's not aware. And oh, by the way, we've got $1.1 million of cash value in the 20th year and a $3.9 million death benefit. How much did that cost them? Well, I don't know, but it seems to say 27 grand back in the first 3 years. So I'm going to keep moving here, but that's the real design of these policies. And Dave simply doesn't know about this, or he's not willing to share with his audience that he does, if he does. The next thing that he brought up was he complains that when you're borrowing from a policy, you're having to pay interest on your own money. Guys, have you ever heard Dave talk about this?
Oh,
Absolutely.
all the time.
Yeah. All right. So you're borrowing from the life insurance cash that's yours. Why would you pay interest on your own money? Is that true, guys? Are you really paying interest on your own money? What are your thoughts?
Yeah, so and this gets a little into the weeds, but when I take a policy loan, I'm not taking out my own money with a non-direct recognition company, which Northwestern is direct recognition. So he's true if he's talking about Northwestern, but if he's talking about a true bank on yourself or infinite banking concept, it has to be with a non-direct recognition. So I'm not taking out my own money. I'm taking a loan from the general fund using my money as collateral. So my money keeps growing as if I didn't touch it because I didn't touch it. And sure, I should pay back money to the general fund that gave me the loan. But guess what? That helps the general fund grow, which helps me continue to get dividends. And all the other people that are also doing this help us all mutually benefit in the same way.
It's awesome. It's huge. Guys.
And I like to think about it as the cost of money, 5% simple interest versus a credit card. Because, you have that $1,000 emergency fund and then you have an emergency and then you got to go use a credit card, and there's a cost to money no matter what, anywhere. So 5% simple, that my money's still growing. On the flip side, that's a powerful thing to me.
Huge. Let's see it in action. I want to show and prove. Again, Dave can say what he wants, and he's got a great big megaphone. So, we're just little ants on his mountain. We're living in his world. But let's look at what this actually looks like. So here's somebody putting in $1,500 a month. Again, 18 grand a year. Dave Ramsey, once again, why would you waste your money here? Well, let's take a look. By the third year, this guy's already got $40,000 that he can borrow against. But here's a world where this guy never takes a loan out. And for the next how many years here, 35 years, he never touches the cash value, and he's got a total of $1.2 million. Keep that number in mind. Keep that number in mind. Without taking a loan against this policy and just socking away cash for 35 years, he's got $1.2 million, and he can start taking a retirement income of 60 grand. Now let's take a look at the exact same policy. But in this case, the gentleman does take loans. Starting in the 4th year, he starts taking 35 grand a year and paying that loan off over 5 years. So are you just paying interest on your own money? Are you just losing all this money due to a super expensive whole life policy? Let's find out. After 35 years, he's bought how many cars? 6, 7 cars there. And he still has $1.2 million as if he had never touched the cash. Dave, can a mutual fund that you recommend do anything like this? Can your term insurance do anything like this?
And if so, show us the numbers.
Yeah, put it up on the board here. Come on, man. Yeah, so it's so true. He says, you need a real financial advisor. You don't want just an insurance broker trying to sell you a load of manure. His words. Wow, harsh words. Dave, if you had more than 30 seconds to listen to this guy's situation and not just go all infotainer on this guy, you might have more of an insight than just referring to a financial strategy as a load of manure. Why are so many affluent clients calling us if this is just a load of manure? Okay. And by the way, what are you selling, Dave? What are you selling?
Didn't he come out of the Primerica world buy term, invest the rest. And my question is, with a lot of the investment world, sometimes we have to ask who's making the most money, the insurance guys or the people that are on the other side of the
we're getting there.
world.
We're getting there, Brandon. Oh yeah, that's right. But just think carefully. Who is profiting from the advice they're giving you? So, Amanda, any thoughts on that?
Well, I would say if you're working with a really good financial professional, you should not feel like they're trying to sell you anything, but that
Right.
they're trying to look out for your best interest and help you find what's going to be the best that you can find in an imperfect world.
So true. Yeah.
And it's going to be multiple things, I would think. Possibly. Yeah. I mean, our financial lives are complicated, and this is just one piece of a bigger puzzle.
So true. I want to compare cross-reference with a real live guy named Dan Proskauer, who was doing the Dave Ramsey thing, investing in the market from 2000 to 2009. And this was Dan's end result. Here you go. So this is the end of the story with Dave Ramsey's investment portfolio recommendations, invest in the stock market. Check out his net worth. This is his Dan Proskauer's real net worth from 2000 to 2009. And look at how much it grew. Guys, aren't you so impressed? I mean, Dan was a specially trained engineer and a very focused individual on growing his finances. And this is as good as he could do. And nothing against Dan. Most of us lost a full decade if you were in the market. This guy's super intelligent, and he still had basically no growth after 10 plus years. But after he started his first bank on yourself type policy, he got real wealth locked in and literally has tripled his net worth over the next 10 years. So which of these two plans would you rather have over the next decade? Guys, Dave Ramsey is waiting to put you back in the market. Yeah.
Well, and I
can't wait to dig into this next slide. I've been waiting for this one.
and I do think, hey, there's nothing wrong with some of that market, but we want to have some safety and stability. And again, it's kind of like the collateral. The difference is the collateral is, instead of your house or instead of other things, we have collateral to grow our business, do other things with.
That's right.
At a really low cost. Where else can you get that? Yeah,
that's so true, man. Liquid capital for any reason. It's awesome. Amanda, so this is where he goes into talking about how he says, oh yeah, the other thing is that your cash value is just sitting there and all of your cash value dies with you. So whatever cash you put into this equals zero at your death because they only pay you the face value. So one, is that true? Can they confiscate my cash value when I die? And if so, what a scam that is, right? So Amanda, give us some thoughts on that. Any thoughts or feedback?
Well, do you have a chart on this one?
Oh yeah. Oh, you know I do.
The numbers don't lie.
Yeah.
Because we could even go back to the other charts you were looking at, and I already knew what we could say from those.
That's right.
Yeah.
But what is it you'd say on a previous chart? You're saying that the death benefit is greater than the original death benefit. Is that what you're saying?
So if you take the original death benefit and you add the cash value at whatever age you want to pick to die, right? Like, so let's pick 85 or something. You take the very original death benefit, you add the cash value. It's probably less than the actual death benefit at age 85 that same year.
Let's look at it. Yeah. So here's a real life policy statement. And the policy was started in 2002. 1 year later, the death benefit went from $245,000 to $253,000. So that's an increase of $8,000. But wait a minute, the premium was only $5,000. So tell me, how did that death benefit go up by $8,000 if you only put in $5,300? That doesn't make sense. And then let's take a look at this one. So from 1992 to 2009, the death benefit went from $250,000 to $390,000. That's an increase of $140,000. But wait a minute. The cash value is only $128,000. So as you just said so well, Amanda, if the insured was to pass away, the beneficiary would get the original death benefit, or Dave Ramsey calls it the face amount. plus all of your cash value, plus an extra $12,500. So Dave, how do you explain this, right? How do you explain this? And Amanda, you brought it up, the previous number. So I had these ready to go. If you still don't believe me, Mr. Dave Ramsey, here's the policy we just issued for a real live client last week. And the death benefit starts at 1.7 million bucks, but in 20 years, he'll have 3.9 million. See that?
Yeah.
So it starts at 1.7, grows to 3.9. Guys, take the original death benefit of 1.7, add 1.1 million. What do you get? You get 2.8 million, don't you?
Almost 2.9.
Yeah, almost 2.9. So where's the extra $1 million coming from? I just gave this guy the original death benefit plus all the cash value plus an extra $1 million. Dave, does any mutual fund allow you to do that? Even if they're doing 12% a year? I don't think they do that.
Right. And term policies, it's pretty hard to find one that's going to increase your death benefit for the same premium.
That's right.
Year after year after year. But your need for life insurance might be going up as your income goes up as well.
Awesome. Well, guys, let's keep going here. So my favorite part is when he said this. He said, anyone who's academically trained or has any kind of CFP or anything else, when they hear someone's just from Northwestern Mutual, we all kind of laugh. That was his words.
Wow.
So I guess I'm supposed to laugh at myself. I know that's an important thing to do in life, but that's not what Dave's talking about, of course. Guys, he doesn't have a CFP. He doesn't have an insurance license. He doesn't have an investment license. Dave Ramsey has a radio license. That's basically all he's got. Okay.
Oops.
Yeah. Oh, and by the way, he does go ahead and plug his sponsor, Xander Insurance. So that was kind of nice of him to do that for us.
Oh, I didn't even catch that he did.
Yeah. So when you get a quote from Xander, yeah. So guess what? He gets paid on that lead when that lead comes in. So that's a great little deal for Dave there. So he does go ahead and bring up commissions, and he's famous for talking about how greedy the insurance companies are, but he's also talking about the greedy insurance agents. So he says, hey, the only thing that's infinite about infinite banking is the infinite commissions paid to the insurance agent. And that's,
I wish.
Yeah, I wish. Yeah. So let's go ahead and do the math on that, right? Amanda, I know you've done quite a bit with this. Would you be willing to quickly explain what we're looking at here? Are you willing to do that?
Sure.
Or okay, got it.
Yeah. So on the right side, we've got a life insurance policy correctly designed. And you'll notice that the commission in the first year is pretty high. And then there's some trailing commission. They go down over time. If you ended up stopping paying premiums, all the commissions would go away. That's not shown here, but that's what happens. And then on the right-hand side, we've got the alternative. Here's your mutual fund with some term insurance maybe. And you'll notice that the commission on that, the annual cost, that's the fee, the asset under management fee, goes up each and every year as the account balance goes up because it's a percentage of the account balance. And even when your account balance goes down, they still take a percentage of your account, right? So even if the market went down, they still take their cut. And this is paid by you. It's taken from your money, whereas the commission paid by the life insurance company is included in all the numbers that you're shown, right? Nothing is actually taken from your policy values. And I forgot to say one more thing about the alternative. If you stop making contributions, there's still a fee paid to the person as long as you keep your money with them. That account balance, they still keep taking fees out of it.
Huge, yeah.
And what's the expense?
What's the total? What's the total expense after 30 years there, Amanda?
Yeah, $6,060.
0.97.
Yeah.
And then the other one is 20.72.
So
I don't know who's stealing here.
So basically you're saying that the money is the same going in, and even if we're looking at moderate returns, 4% basically over 30 years, higher returns would mean even higher fees paid to the investment advisor. But we're looking at, help me out, is that 18 times more money to the investment advisor over and against what that greedy insurance agent might get paid? Dave, you are wrong. How do I say it any more clearly?
I picked the wrong industry.
Yeah. So guys, just a moment that it's almost over, his video and ours. So thank you for going through this with us. But he says at the end of his video, he recognizes that this guy is likely a millionaire, but he dismisses it. And he says, the guy, this Jason guy likely didn't move forward with his whole life, even though he thought it was a pretty good idea. He says he should dismiss infinite banking because the Holy Spirit should tell you not to buy whole life insurance. The Holy Spirit should tell you not to buy whole life. Wow, is all I can say to that.
Really?
Yeah.
I didn't
yeah.
didn't catch that either.
Yeah, it gets crazy. So guys, we do think that there's more to this. If you want to dive deeper, we've got more fun on our audio podcast, Not Your Average Financial Podcast. If you go to our website, nyafinancialpodcast.com, look up episode, just search for Dave Ramsey. That's what that little URL at the top there is saying. If you search in our search bar for Dave Ramsey, you'll find our 4 episodes where we talk about him and his specific things that we love about Dave. Because he's not all bad. He's good. He's a good guy. We like him too. But there's some things he just plainly gets wrong. So I'd say drop the entertainment and get educated. It's easy to get advice from the internet, and you don't want to do this for your medical health, and you don't want to do it for your finances. So find your own answers. Don't let Dave's video tell you what to believe. You want a competent professional, come check us out and schedule an appointment. Brandon, Amanda, what are the best ways they can get in touch with you guys?
Before I give you that, we have a video that we shared of Dave Ramsey's advice. How's that working out for your parents? That just came out a week or 2 ago. And just asking those questions. And the other thing for me, I ask is, hey, why are we doing what we're doing? It's because it changed our life. It really helped us get out of some bad situations as we are entrepreneurs and be able to leverage positive situations as, using that cash in the policy to buy a home, do other things, all kinds of things. So you can find us at Grandma's Wealth Wisdom. I do think that they had some wisdom back in the greatest generation, and they modernized these whole life tools to be more modern. But learning from the greatest generation. And so if you go to Grandma's Wealth Wisdom, you'll find us, and you can schedule a meeting with either one of us or anything else, Amanda.
And if I can add one more thing, I saw in your list of episodes, Mark, Pamela Yellen mentioned, and I know she's been inviting Dave Ramsey to debate with her for years and years and years, and he hasn't been willing to do that. He won't accept her invitation to a one-on-one debate that's maybe public and put out there for people to see both sides of the story. And so Dave, if you're catching this video, I extend that challenge. I remind you that invite's out there, and we would love to see that happen.
And if Pamela can't do it or is not able, I'm sure Mark could do it. Mark would love it, right?
Yeah. Oh man, I'd love that. That'd be so fun. Yeah. I'll be a CFP, one of the wonderful CFPs you always love to have on your show. Not only would Pamela love to debate you, Dave, but she'd be willing to pay you $100,000 if you can prove her wrong. So talk about that's better than your 12% mutual funds that you're famous for saying, Dave. So we'd love to kindly suggest opening up and thinking critically about your own advice. Or if you listen to Dave, think critically about Dave's advice and ask yourself, is he 100% true all the time? Or is it possible that Dave Ramsey could be wrong about something? So with that, guys, have a wonderful rest of your week and keep learning, keep searching.
Awesome. Thanks, guys.